There is a quiet shift that happens around a number most people don't consider life-changing, and yet it often marks the first real turning point in how money behaves, not just in your bank account, but in your mind. Imagine someone who has spent years operating in a cycle where every dollar has a destination before it even arrives, where income flows in and immediately flows out, covering obligations, small comforts, and the constant friction of living. Then, gradually or suddenly, that same person reaches a point where they have $20,000 set aside. Nothing external announces the change. There is no visible upgrade in lifestyle, but internally, the system begins to operate differently. At lower levels of savings, money functions as a tool for survival and short-term stability, which creates a psychological environment defined by urgency. Decisions are compressed into short time horizons, and even small disruptions feel significant because there's no buffer to absorb them. But at 20,000, something subtle begins to emerge, which is optionality. The presence of a financial cushion starts to decouple immediate income from immediate necessity, and that separation is where wealth-building behavior becomes structurally possible. What makes this threshold interesting is not the number itself, but what it represents mathematically. If we assume a modest annual return, even something conservative, the dynamics begin to shift from purely linear accumulation toward the early stages of compounding. At very low balances, growth is almost invisible because any percentage applied to a small base produces negligible results, which is why saving often feels unrewarding in the beginning. However, once the base reaches a level like 20,000, even small percentage changes start to produce outcomes that are noticeable enough to influence behavior. For example, a 5% annual return on $1,000 produces $50, which is easily ignored and quickly absorbed by normal spending patterns. The same 5% applied to $20,000 produces $1,000, which begins to register as meaningful, not because it replaces income, but because it demonstrates that money can generate additional money without direct labor, even if the scale is still limited. This is often the first point where the abstract idea of compounding becomes psychologically real rather than intellectually understood. There is also a structural shift in risk perception that tends to occur around this level. When savings are minimal, taking any financial risk feels dangerous because the margin for error is effectively zero. At 20,000, the presence of a buffer allows for more deliberate decision-making. This does not mean reckless investing or aggressive behavior, but rather the ability to think in probabilities instead of certainties. People begin to evaluate trade-offs differently, considering longer-term outcomes rather than immediate consequences, which is a foundational mindset for wealth accumulation. Another dimension of this threshold is how it interacts with fixed costs. Many financial pressures are not variable but static, such as rent, utilities, or basic living expenses. When savings are low, these fixed costs dominate the financial landscape, leaving little room for flexibility. As savings grow, even if income remains unchanged, the relative weight of these costs begins to decrease. 20,000 does not eliminate fixed expenses, but it changes their psychological impact because they're no longer existential threats. Historically, similar patterns can be observed across different economic environments, where individuals or groups that reach a certain level of surplus begin to transition from purely reactive behavior to proactive strategy. This transition is not dependent on extreme wealth, but on crossing a threshold where stability allows for planning. The exact number varies depending on context, inflation, and cost of living, but the principle remains consistent. There is always a point where money stops being only a constraint and starts becoming a tool. It is important to understand that this threshold does not guarantee progress, and it does not automatically lead to wealth. What it provides is the first realistic opportunity for different behavior. Without a shift in how decisions are made, the advantage can disappear just as quickly as it appeared. However, for those who recognize the change, 20,000 often represents the moment where money stops being purely reactive and begins to include elements of control. Over time, this shift compounds not just financially, but behaviorally. The ability to wait, to allocate, to evaluate, and to resist immediate consumption becomes easier when there is evidence that patience produces results. This creates a feedback loop where small gains reinforce disciplined actions, and disciplined actions increase the likelihood of further gains. In the end, the significance of the $20,000 threshold is not about the number itself, but about the transition it enables. It marks the point where money begins to operate with a different set of rules, where time becomes an ally rather than an adversary, and where the possibility of building wealth moves from theory into something that can actually be observed, measured, and gradually expanded.